Okay, welcome to the section about the order flow. In this section, I will quickly make a recap of things that I've been talking at the beginning when we were talking about the market microstructure, and then we will take a look at the different tools and how you can use them with a price action. Altogether at the end. Basically, I will also kind of mention what tools are good for different trading styles. So first of all, the fallacy of order flow. Obviously, unfortunately, a lot of people who are selling courses about the order flow tend to present it as any sort of a holy grail to trading. It is what it is, but this thing really became quite a popular thing to sell, and people charge thousands of dollars for any kind of a courses. They even mention the order flow. There are a few issues with this, besides the obvious fact that there is no a holy grail to trading, but the problems with order flow are that markets are fragmented. Obviously, crypto, you have a lot of different exchanges in crypto. This is your kind of a fragmentation. You have so many order books in crypto where it can get a little bit of confusing. For example, if market is going to the level and Bybit is heavily buying and FTX is heavily selling, like what is going on? What is that information you want to be taking from it? Luckily, in crypto, behavior of retail traders on these futures exchanges is usually the same. So you won't see these things going, against each other too often. Another problem is what people tend to do when they are new to these things. They don't know which tool to use, because obviously the lot of order flow tools are just indicators, and people think that if they can use a RSI on 5-minute time frame, they also can use it on a weekly time frame without any sort of issues. This is not the case for order flow trading, because as you, I'm sure you remember when I showed you a depth of market, it's a market microstructure. It's called market microstructure. So using a footprint chart on a daily time frame doesn't make any sense, because you are basically looking at these kind of immediate actions in the market, and you want to be benefiting from them. The longer time you give people to reposition and do basically anything, the less your edge is in that. So a lot of these order flow tools are really short term. When we will be moving to higher time frames, I will show you the things you should be doing, and this will obviously lead to not using a wrong tools when they don't belong. Different behavior in different markets. Also, what people often see, that they can trade any market. This is usually when it comes to day trading, that you can trade Nasdaq, watching a order flow in that market, and then just one day decide to switch and trade bonds. This is not how things work. Every market has its own kind of nuances. Besides, markets having different liquidity, they also behave, differently. You have the spoof orders, the traps, and everything is a little bit different for each market. So you need to, if you want to go this way and really focus on looking at things from kind of a zoomed in perspective, you need to stick to the market of your choice, basically. So It's not a holy grail or just kind of a one-way street to anything. There are different kind of things you need to pay attention to. So order flow in the different markets. Like I said, there are thin and thick markets. On the right side you can see two DOMs. The one on the left is for a Eurostoxx 50. Like I said, these are the biggest 50 companies in Europe traded. On the stock exchange on the right there is a DAX 40 biggest companies in Germany. These two things are highly correlated, which means they basically move hand in hand. Yet you can see the different liquidity these two markets have. As you can see, there are around 200 contracts at each price levels in Eurostoxx. There are only 10 to 20 on each price point in DAX. This means that DAX will be much more a volatile and jumpy market, which most people are immediately drawn into because they think that volatility is always a good thing, but there are cases where trading something like this is actually much better, where you have a time when you see what is going on. This is much slower. Obviously it takes more time for prices to move from one point to another, but also all these kind of things you want to pay attention to. All these details are much cleaner to see on this ladder compared to this one. Spot forex and currency futures, also something I mentioned. You can trade currency futures, there's no problem with that, but you will often find out that the most important things are happening in the spot markets. Okay, so this obviously can lead to a very confusing order flow in the currency futures. So if you can, I would choose a different market. It's not impossible to trade these currency futures, but I would try to choose something else. Spot versus futures crypto markets. Once again, there is completely different meaning of different things when it comes to crypto. You have a lot of exchanges. What is important here is there are people who trade spot and people who trade futures. Usually, or people who trade spot have first of all, they are not shorting, they are only buying and then selling into cash. Basically, there is no short button in trading spot. And also these are those with the heavier hands. So there are a bunch of these tools. I personally don't use them in crypto, as I think that the things that I do are more than enough to make any educated guesses. But when you see, for example, in crypto, spot is buying and futures are selling, is usually a bullish signal. When you see the things opposite way, it's usually a bearish thing. But all these things, you need to pay attention to them. You need to really decide what you will going to trade and sticking through it and learning all the different nuances. Order flow is not really is one of those things that really gets better with your screen time. When you will see these things for the first time, you'll most likely get really confused, but then more time you spend in front of charts, the better it will get. So make sure to understand that. Passive and active order flow. There are two types of order flow. I briefly covered this as well. The passive order flow are the limit orders resting in the order book. These are used by the smarter players, the people who are trade with the larger size and they don't want to market into the trades. They make liquidity. There are liquidity makers, and more passive order flow, the less volatility. We also covered this in a section about the markets. The passive order flow is the advertisement, so they can place the limits into the order books without any intention of filling them, and they are usually the heavier hand. What you can see here is this is a heat map for some bond market. I'm not sure which one is this. You can see how the size is really, how in this case this is a 10-second chart, and you can see how someone is going to post a size here, they're going to fill him here, but he will just kind of persist. So this is one of those cases where you have a large size in the market, but he's not spoofing it, and then I think he kind of get filled and the market moved on from there. The active order flow are the market orders. You can see them here. This is the cumulative volume delta. We will cover this in a bit. These are the market buyers and sellers in these kind of this, like I said, shows the market orders. They are used by the retail traders is not the best kind of term to use, but overall the smaller speculators who just don't want to wait for any favorable prices, they are liquidity takers, because obviously they are taking the liquidity from the order book. The more active order flow and less passive order flow, the more volatility. Once again, we talked about this. The less liquidity in the books and more market orders getting in, market will be more volatile. There are the weaker hand in the market. Different tools for the different trading styles. This is where it essentially comes important. If you will be scalping, you basically want to utilize all the tools that are available. I am not scalping. This is not geared towards scalpers. But if you will be scalping, using DOM, footprint, cumulative volume delta, and heat maps, it should be utilized. Day trading, this is more of a approach that I always did, and still kind of do, even though now I'm kind of using it, for example, more of a 30-minute chart. But day trading by itself, when you really want to be flat at the end of each day, then the footprint and cumulative volume delta are your kind of two go-to tools. If you will be swing trading, and this is 30-minute plus, but I would not, for the footprint, like using a footprint on a 60-minute chart is the highest I would go, basically. If you don't have that much time for trading and you are really going to be using only H4 time frames, for example, then you will be just using the volumes at inside each bars. But so footprint, maximum of hourly time frames, even that I think it's a little bit too much, but but you can see when there is no CVD, there is only a footprint, there is only and then just higher you go, only volume. Okay, so let's take a look at these tools in more detail.